The war in the Middle East is applying pressure on international oil supply, with surging gas prices threatening to reverse Canada's inflation progress. Statistics Canada said today that Canada's inflation rate fell to 1.8% in February. Those numbers take into account the end of last year's tax holiday, but don't yet reflect the impacts of the war in the Middle East on the economy. With lots of uncertainty around the economic impacts of this conflict, we turn to economist Don Drummond, who is a Stauffer Dunning Fellow in Global Public Policy at Queen's University. Hi, Don. Thanks for coming on.
You're most welcome.
So this inflation reading from Statistics Canada today has many caveats, of course, but on the surface, it looks like good news, right? Inflation cooled to 1.8% in February, so prices were, about 2% higher last month than they were in February 2025. What's your read on the figure that was reported today?
I think we need to do what the Bank of Canada does and look at their special three underlying measures, because the last month, February, was half tainted because we had that temporary GST holiday on some things. So that kind of messed up that number a little bit. The other half of it's going to come off when we get the number for March. And then when we get into April, now we're going to have the entire year of not having the consumer carbon tax levy. So the numbers are pretty difficult to read as the headline numbers. The Bank of Canada looks all through that. They look at underlying trends. They have their own three measures. They've been bouncing. They were in the low threes for a long time. They just barely dipped in the high twos. They're now all in the low twos. They're either 2.3 or 2.4. So not quite at the bank's target of 2%, but very close, finally, after years.
You mentioned March. There's the potential for an ugly figure in that month because gas prices and what they've been up to over the last little while, they're up, 30 cents a liter or so in some parts of the country as a result of what's going on in the Middle East. Are you anticipating an inflation shock as a result of the Iran war?
Well, we're certainly going to get that in the measured rate. The rate for March unambiguously will be at least 2.25. It could be even 2.5. We will get a high number in April as well, because now the elimination of the carbon tax has been off for 12 months, so that's in the base. So we're looking at two consecutive months of 2.25 to 2.5. Now, that is a relative price change. It's one thing driving it, is price of oil and natural gas showing up in the gasoline at the pumps and in home heating. It's not generalized to the rest of the economy. If it doesn't spill over to the rest of the economy, for example, if it doesn't lead to higher wages, it too should fade out if and when the oil price comes down, or it'll even fade out if the price stays up for a number of months. So I think it will be a relative price change rather than a permanent increase in the rate of inflation.
On the issue of oil, obviously oil prices are a boon for Canadian producers and the governments that collect royalties and taxes, but it's painful for consumers, right? It exacerbates the cost of living pressure that many people are struggling with right now. Do you think that this oil price shock is a net negative?
Well, in a very static world, it should be a net positive. We are a net exporter of oil and natural gas, but there's a but behind that. We're also the quintessential small open economy. And this is really serious business for Southeast Asia. We keep talking about 20% of the world's supply of oil and natural gas goes through the Strait of Hormuz, but that is the source for Southeast Asia, the Indias and the Vietnams and the Chinas. So it's not even a question of just the price. It's a quantity of effect. You just can't get the quantity of it. So if it weakens those economies, that will weaken their production. It will weaken their ability to buy our exports. So there's knock-on effects. So I don't think it's a crushing effect for the Canadian economy, but I don't necessarily see it as a positive sign. But as you indicated, all kinds of distributional effects. If you're an oil or natural gas company or you own shares in this, yeah, that's on a net positive basis. But the rest of the country is a net consumer of oil and natural gas. Another hit on household budgets where they're already being stretched.
Yeah, and folks in Japan, too. I was just there with the Prime Minister. It's a big concern for them because 87% of their energy they import. So they're hugely reliant on that part of the world, on the Middle East, for their energy supply. Let's talk about employment for a second, if we can, sir. The recent StatsCan data did not paint a pretty picture, as I'm sure you saw. We lost about 84,000 jobs in February. Most of them were full-time positions. The unemployment rate ticked up to 6.7%, lower than it was last summer, but still, relatively high. Are you worried about the job market at these levels?
This is why it's been interesting to see so much attention on the uncertainty of the oil prices, because we really need, just as you just did, to back up a bit. Things weren't looking too good before this all started. And let's go to the US first. First of all, a lot of their job gains that they thought they'd realized in 2024 and 2005 got revised away. And then they had a big decline in employment. They were expecting a big increase in employment. They got a big decline in employment. And now Canada, we've had two consecutive declines. The first one not too big, but the second one is a very large decline. So the economy is not doing too well. We're having interesting geographical effects in Canada. Ontario is bearing the brunt of it. Not surprising in the areas hit by the tariffs. So you look at steel and automobiles, obviously they're concentrated in Ontario, and those are the areas are having the greatest difficulty. But we've typically had the unemployment rate for Ontario at or below the national average, and now it's well above the national average, and shockingly above the levels in Quebec and Saskatchewan. So again, we're seeing sharp distributional effects, but certainly Ontario, and that's 40% of our economy, is having a hard time. And that was before any of the Iran, US, and Israel business started to affect us.
So where does this leave the Bank of Canada then? You know, obviously they have this interest rate decision to make, or to at least announce on Wednesday. Are you expecting a cut, or do you think the Governing Council will keep the rate where it is, given what we've just talked about? The policy rate's at 2.25. Do you think it will go higher or lower on Wednesday?
I think level is really important, more so than the change. 2.25 is the bottom of their end of a neutral rate. So they ask the Bank of Canada, what's the interest rate that's not stimulating the economy? It's not slamming on the brakes. And they've always said 2.25 to 3.25. And they stayed in the middle for quite some time at 2.75. Now they're down at 2.25. So their attitude is, look, you keep asking us if we're providing stimulus. We are providing stimulus. We have been for some time. We're 50 basis points on the side of the stimulus. And I think they'll stick with that story. Yes, we're providing stimulus. Is it a huge amount of stimulus? Is it as much as it was a number of years ago? No, but there's a lot of uncertainty in the economy. Yes, they're not supposed to react to one-time relative price changes like the oil prices, but they do have to worry that that can pass on to inflation. So I think they'll sit there and worry, but not take any action. We'll stay at 2.25 again.
Can I ask you about stagflation, that dirty word? You know, the last time this came up was the 1970s energy crisis, but there's a lot of similarities between what happened then and what's happening now in a way, right? Inflation up, oil prices high, economic growth slow, unemployment mixed. Is there a chance we'll see a repeat? Should stagflation be in our lexicon now?
There's one thing that's changed, and it's not a pretty picture. That is what the normal rate of growth would be. So in the 1970s, we had large increases in the labor force participation rate. This was the beginning of a lot of women coming into the labor force that hadn't been in before. And we used to think the productivity had slowed down. It wasn't so great, but it was running about 1.8% a year back in the 1970s. Take off the one, now it's 0.8. So it's slower. And what very few people seem to understand, we are going through a multi-year adjustment to immigration numbers that are a fraction of what they were. We were running over 1 million immigrants per year for 3 years. Our target for permanent residents is 350 to 385. A normal change in employment month to month, given what's happening in our demographics, is actually a slight decline. So everybody's looking, employment's going to go up 20 or 30. So that wouldn't be normal. That a normal for the next kind of years is a negative number on employment and barely positive for output. So stagflation actually has a nastier touch to it this time around. It could get the inflation side, and the growth could be even weaker than we saw before.
Not great. Not a great note to end on, but we will. Don Drummond, thanks for coming on. Nice to see you, sir.
Okay, thank you. Bye.